So I've taken a couple of trades over the past weeks, and there's a lot I've learned when it comes to the ICC trading strategy I would like to share with you. Now, does ICC work on every pair? That is one of the questions that people ask. But before we discuss that, there are some things that I would like to share with you. So the first concept is the baseline concept. So baseline. Now, what is the baseline? It's very simple. The baseline concept is something that must be fulfilled before you trade the ICC trading strategy or any strategy that you might trade. The baseline concept. Now, ICC is a market structure dependent strategy. Okay, it's a market structure dependent strategy. Now, what does this mean? It means that ICC depends on market structure a lot. Now, you might have heard this a lot, but sometimes we tend not to internalize some of these things. We just put it in our minds, but we don't internalize them. That is, it doesn't affect any action we take in trading, no matter how small, right? So market structure is the basics or foundation of ICC. And what it means is that if you are trading any pair and then market structure is giving you 80% win rate, your ICC is going to give you an 80% win rate. If market structure is giving you 20% win rate, ICC is going to give you 20% win rate. Now, this is very important, which means that for any pair you decide to trade, right, the first thing you must check is the baseline. How often does price trend on that particular market? Else, anything you're going to do here is going to be, sometimes you might become really good, but price is still what it gives you, right? No matter what you do. So the first thing you must take into consideration is that ICC works only on trending markets. Only on trending markets. ICC works only on trending markets. So you have to internalize this, not hear it. Internalizing it means that you have to make sure it affects at least one action that you take in trading. So before you trade any pair, go to the higher time frame. It might be the 1 hour, right? The 1 hour is the standard time frame. If you want to, be a day trader, right? You can just use the 1 hour time frame, right? 4 hour time frame is for swing traders and stuff. So you go to the 1 hour time frame, you see how many times, or you check how many times price trends on the pair you want to trade in a week, right? Take 1 week, take the previous week, check how many times price trends on this. If you have a pair that gives you an indication, okay, let's say price gives you an indication, then it gives you a correction and somehow it breaks down, and then instead of moving down, it moves up, and then it's all over the place, right? This type of market structure is very confusing, right? And it's going to give you confusing results, if you understand what I mean. So you have to ensure that you check your trade or the pair you are trading. If for some reason that specific week price is deciding not to trend, then you shouldn't trade ICC on this pair, because you're going to be losing straight away, right? Because ICC is market structure dependent. It depends heavily on market structure, right? If market structure is not working, ICC is never going to work on your pair, right? Or on the pair that you've decided to trade. So this is a first test that you must do, right? So you ensure that market structure at least gives you something. Now, sometimes this can be, less, accurate, or market structure can be less accurate on, maybe the 1 hour time frame. If that is the case, just move on to the 2 hour time frame. Check if the 2 hour time frame was at least trending, right? So if the 2 hours time frame was giving you some kind of trend, then you can use the 2 hour time frame, right? 2 hour time frame. So if market is not trending on a 1 hour time frame, check if for that pair it's trending on a 2 hour. If it's trending on a 2 hour, then you can use the 2 hour time frame. So that is the first concept that I'd like to share with you today. ICC is market structure dependent. You have to internalize this. Before you trade ICC on any pair, you have to check if the pair is trending on a higher time frame. If it's not trending on a higher time frame, then you're wasting your time on that pair, right? This is one thing I've learned personally. You can, take it and apply it, right? Or you can check if it's true for yourself before you apply, right? Now, the second thing I want you to take away is that, or let me rephrase my speech. So the second thing is how you can, choose your entry time frames, right? How to choose entry time frames. How to choose entry time frames. That is the second thing I'd like to share with you. Now, this step, is very confusing for most people, but I think I've found the best way that you can choose your entry time frames. Now, you have a lot of time frames to choose from. Okay, you have the 5 minutes to choose from. I think let me start with the 3 minutes, because sometimes the 3 minutes trends, then your 5 minutes time frame, and then if you have access to the 10 minutes time frame. If you don't have access to the 10 minutes time frame, if you're not in a premium version of TradingView, you can use your broker app, right? Each broker allows you to have access to each and every time frame that you need, right? So that you can trade well with that broker. Even if you don't have access to lower time frames on your specific broker, you can use XNES. XNES has or provides access to all time frames. Okay, so you can check it out. I'm going to be leaving a link in the description. Now, you have your 3 minutes, your 5 minutes, and your 10 minutes time frame. Okay, and then you have sometimes your 15 minutes time frame. 15 minutes time frame. Right, it's depending on what you are trading and when you are trading it. So how do you choose between any of these time frames to enter the markets? Okay, now before you choose any lower time frame, so let's say price has given you an indication on the higher time frame. This is the higher time frame, right? And you're waiting on that lower time frame. How do you choose this time frame? Okay, how do you choose this time? Let me make it yellow. How do you choose your lower time frame entry? That's basically what I mean here. So the best way to do this is to go to a day before or 2 days before, right? So you don't need to go a week before, a month before. That is old data. You need fresh data from a day before or 2 days before. The most best one will be from that week. If you came to the market on Monday, just check Friday's price action, right? You need to check if price was respecting the trend, the lower time frame trend on the 3 minutes or on the 5 minutes. If price was not respecting lower time frame trend on the 5 minutes, it is not encourageable or advisable for you to use 5 minutes as your entry time frame, because there's a high chance that price is going to try and break structure most of the time. For example, if you have lower highs and lower lows, and then price gives you an indication on the 5 minutes time frame, and then it just goes down for some reason, and then it starts trending down, and then it gives you another indication, you might want to check, right, for this. Now, there are two ways in which you see if you can use that time frame as your entry time frame. So let me go back again. Now, if price is moving such that you will not lose a trade, so let's say price is giving you lower highs and lower lows, lower highs and lower lows, it give you a lower high, then a lower low, right? And price gives you an indication. Normally, you're supposed to enter if price comes back above this. Now, assuming price doesn't come above this, right, and it sells here, right, it keeps going down, or it indicates that the correction or the continuation has not yet begun. This is a trade you wouldn't have taken in the first place. You wouldn't have lost. This would not count as you not considering that time frame as your entry time frame. What would count is if price broke above this. That would mean that price is set on making the continuation. So if price doesn't make the continuation, right, and let's say you enter a trade and then you see that price breaks down, right, and it keeps going down. For that pair that's weak, you might not want to use that time frame that you experience the loss on as your lower time frame, right? And you don't have to experience a loss. That is why I asked you to check 2 days or 1 day price action before, right? So if you want to choose 5 minutes, check 1 day's price action or fresh data on the 5 minutes time frame. If it was trending, you can use it. If it was not trending, it is not advisable for you to use it. You can use it at your own risk, but it's advisable for you to switch to a much higher time frame. And sometimes when you switch to the higher time frame, realize that on that time frame, price is actually cool. It is trending beautifully, and all you just have to do is wait for an entry. And I'm going to show you an example of this. So make sure you pay attention to price action on the lower time frames. Before you choose a time frame, you can check fresh data for that time frame. If price was trending, use that time frame. If it wasn't trending and it was breaking, don't use that time frame, right? And I'm going to show you examples. And this is very important because it might help you increase your win rates, right? Sometimes there are some things that you have to factor in, okay? And that moves, or that sends us to the third point. The third point is that you have to consider externalities. Externalities. Let me make this big. And when I say externalities, what do I mean by externalities, right? So externalities are just things or situations or conditions that are not part of the ICC trading strategy, but you need for your specific pair that you trade. Okay, so scenarios that are outside the ICC but is needed on the pair being traded, right? Those are externalities. Let me make ICC caps. So scenarios that are outside ICC trading strategy but are needed, right? These are externalities. Now, what do I mean? Now, let me show you an example for US30. Okay, so for US30, previously, for those of you who trade US30, you might be able to relate. US30, what happens is that when price gives you an indication on a higher time frame, okay, indication on a higher time frame. Let me make this green, higher time frame. And then what happens is that on lower time frame, price corrects, price gives you a correction. Let me color code this to yellow, right? Price gives you a correction, and it's going to give you an entry model, okay? But what happens is that when you take your entry, normally price just wicks out for no reason, and then it moves towards your direction. It wicks out for no reason, stopping you out, and then it leaves a huge wick or something. Then it moves towards your direction, right? This is something that occurs on pairs that are heavily manipulated, like the forex pairs, right? And US30 or Nasdaq or US Tech. For those of you who trade or who used to trade this, I think just a few months before, you relate to this. So if you want to trade a pair like this, you need to factor in the liquidity grab as an externality. So let me put liquidity grab here. Liquidity grab as an externality. Why do you have to factor liquidity grab as an externality? Because there is a high percent chance that even if price gives you an entry model, okay, remember those trading the SMC, they are seeing this as change of character. They are seeing this as change of character, and they want to take an entry. Okay, so let me put a text here. They are seeing this as change of character, right? And they want to take an entry or maybe change of character here, and then a break of structure here. Right? So you are basically almost taking the same entry as the the SMC guys, right? But you are using the ICC instead. So the the banks and then the markets, the liquidity providers, they know that people are going to put their stop loss here, right? So they are going to try and grab liquidity or do some sort of week out or something. So you might want to factor externalities such as liquidity gaps when you are trading pairs that have a high chance of this occurring. Okay, and I've realized that when you do this, okay, you tend to get a high risk reward, because normally when price grabs liquidity, it means that it's going to move with a lot of momentum. Okay, because it has grabbed a lot of money, it has exchanged people's, when you take a buy, your stop loss is a sell limit order. It means that when price comes back there, you want to, or price is going to tap you out, or when it gets there, you want to sell your position, right? Now, if you sell your position, it means that price is going to exchange all the buy orders, right, with your sell order, which you have there, right? So you sell your position, and then you have millions of people selling their position. If you want to understand this concept, you can just watch my first video. Then price has a lot of capital now, right? Because most people have sold their buy positions for sell positions. So price tends to move with a lot of, momentum. And this happens on Forex pairs and, these indices, right? So you have to pay attention to externalities on your trading your strategy. If you are trading ICC, you have to include externalities.